today's video, we'll be talking about the definitions of financial statement elements. There are 5 key elements: assets, liabilities, equity, income, and expenses. So let's go through each one. These definitions are based on the most updated version of the Conceptual Framework issued in 2018, and it's slightly different than the past. We used to define assets as a future economic benefit expected to flow to the entity. Now they call it a present economic resource. So what's an economic resource? It's a right that has the potential to produce economic benefits. The new definition deleted the word expected, meaning that the flow of economic benefits to the entity doesn't have to be certain or even likely, as long as we have the control and it's a result of a past event. So the key components to remember are: it has a right to produce future economic benefits. So it's not about the physical item, but it's the right to get benefits from them. It's a result of a past event, meaning something must have happened for the entity to obtain that item, such as a sale. And the asset must be controlled by the entity, because if it's not controlled, then it's not really theirs to use. But be careful. Owning isn't the same as controlling, because an entity doesn't have to own an item to have control. For example, a lease. We can lease an item from someone else who owns it, but you control it and you get the benefits from that item for the period of that lease, such as equipment or property, and we still have to record it in the balance sheet. So here are some examples of assets. We've got cash, trade receivables if an entity made a sale on credit, and there are also non-current assets such as property, plant and equipment like buildings and vehicles, and we also have intangible assets such as brand names, licenses, copyright, etc. So let's move on to liabilities. The new version of the Conceptual Framework also slightly changed the definition of liabilities, but it's mostly the same. It's a present obligation to transfer economic resource, such as cash, because of a past event. So we've incurred a debt. For example, if we bought something on credit, then we have an obligation to pay back that amount in the future. The key components are: is there a present obligation? We have to be careful here because it might be a possible obligation, a provision, or a contingent obligation. I won't dive into the details of those here, but feel free to watch my previous videos if you want to learn more about provisions and contingent liabilities. Is there a transfer of economic benefit? And it must be a result of a past event. Let's look at some examples of liabilities. We have trade payables when we buy items on credit. We have borrowings or loans from a bank. There can be employee benefits for any leave entitlements that are to be paid out, and we can also have leases. Now let's quickly go through the examples of how a liability might be settled. It can be settled through the payment of cash, which is quite obvious, and we can also use other assets to pay off a debt. For example, when someone pays you cash in advance, you then subsequently provide them with a product or a service. You can replace it with another obligation when refinancing or rolling over a debt. For example, from a credit card debt to a long-term debt. And we can also convert it into equity. This normally happens when you don't have enough cash, so you pay off the obligation with shares from your own company. Next is equity. You can't have a balance sheet unless the asset lines up with liabilities and equity. So equity is the residual amount to make the balance sheet balance. Basically, it's the difference between assets and liabilities. This might include issued capital, retained earnings, etc. The Conceptual Framework provides us with a fairly complicated definition of income. The two essential characteristics are there's an increase in assets such as cash or a reduction in liabilities such as unearned revenue, which is when we may have received cash but not yet delivered our service or product, and an increase in equity other than a contribution from owners. So what it's essentially saying is that we've made some money. So if we sold something, then we have ourselves income. Examples include sales revenue or interest revenue. And expenses is just the opposite of income. So there's a decrease in assets, such as paying cash, or an increase in liabilities, and a decrease in equity other than equity distribution. Expenses may include items such as salary, marketing, stationery, utility costs, etc. I hope you now understand the 5 elements of financial statements because this will provide the foundation for other accounting concepts.